Welcome to India Market Open. It looks like another pleasant morning. It's been a good run, guys. I've got with me Tamanna and Niraj joining us. As a gear you up for trade this morning.
It's been a good run. So far, so good. And as much as we are looking stretched, the global markets are just helping us move ahead. The rising tide is carrying all boats.
What a set of numbers and data points have come in overnight, which can really give us a sense of how markets will trade today. So let me begin with that. You know, you would think that the excitement would be built in after the Fed spoke and U.S. markets rose, but no, yesterday was a great day for U.S. markets as well. So let's quickly start with that global check. The Dow managed to close over 37,000 for the first time. We'll run those rates as well once. But there was a slew of data because remember, the whole idea is whether the U.S. economy will have a soft landing. That means inflation gets controlled, but the U.S. economy doesn't slip into a recession. How would you do both? So U.S. jobless claims came in yesterday at lower rates than was expected. So that was good. At 202,000, this was below expectations. So less unemployment claims. On the other hand, November retail sales were higher than was expected, so 0.3% stronger in November. In fact, they dropped 0.2% in the month of October. So they beat estimates. What is that telling us? Less people are looking out for jobs and they're spending more. So that's a good point for the U.S. economy, although no big concerns on inflation. The U.S. 10-year was the other big headliner, below the 4% mark for the first time since August at 3.9%. In fact, crude rose about 3% overnight on the Fed decision. The Brent at $76 per barrel or thereabouts. And Bank of England also kept its rates unchanged at 5.25%, though warning there that they're not yet done with fighting the inflation demon, nor is the United States. So all in all, the cues continue to remain positive. You've also seen that, you know, we have to see what the ADRs are, and I don't know if we can pull up the ADRs. We saw fantastic rates on the ADRs for Infosys, etc. So the big question, Niraj, this morning will be whether IT can continue its dream run, whether banking gets even better, and we'll come to those FI flows in a bit, but do the fund flows start building up even higher, or do we wait for the Christmas break and then resume in June?
You know, for a change, the ADRs followed what Indian markets did as well. So that was the key point. But IT looks set for some more gains because yields continue to come off. Yeah. Yesterday at 3.94, there has been a good move. And so, yeah, I mean, good questions. In fact, you know, there's a point that I want to make on banks as well. First on the trade setup. Just laying out the lay of the land, that the screen does look stretched, but the global market momentum may well help the momentum to continue, and we might see more upsides. But the key point, and Tamanna was speaking about banks, you know, if you just look at the last 2 days, what has carried the markets higher is not banks but IT. To be very fair, it is IT which has done really well. So banks are participating, but not participating with as much gusto as you would probably expect banks to do when the Nifty or the Sensex have done what they have done thus far. And therefore, one, does it leave the room for some more upsides? Probably does. Does it also aid the belief that if there is a downside, there could be money that could come in? Yes, because ask any person right now that we have, everybody talks about how the money will come into banks from the FI side. Remember, FIs typically go into a holiday starting today, tomorrow. There's a Nomura note which was already saying, wishing people a happy holidays this morning. They come back Jan 8, Jan 9, Jan 10th, and that's when the allocations get set for the EMs as well. So might well see the large money flow into large caps coming in around that time. But be that as it may, for the near term or the very near term, banks give a bit of a cushion. And two spaces that certainly need to be focused on. One, you've seen tide turn a little bit. Actually, first, defense and railways. Watch out for both of these. India, 1.1 lakh crores worth of new order wins, or new orders to be given very likely over the next 5 years. There are some order win announcements as well, which I think Samina or Tamanna will bring up as well. So railways comes in focus today. And defense, as much as it is a very individual country-specific thing, you saw the U.S. Congress pass an $880 billion bill for defense spending. That is huge. And just shows the lay of the land, like I said. So Watch out for defense and railways in the session today. Something tells me that there could be some more stuff in defense stocks in the session today. And the tide is turning in chemical, specialty chemical and CDMO stocks. We had Vikas the day before yesterday talk about that. We've seen a very interesting announcement from Ami Organics that we will talk about as well. So lots happening within sector-specific moves. Let's see if IT indeed remains the one which helps the market do more, or do we need to take the aid of banking?
Niraj, I don't mean to be a wet blanket here, but this exuberance is looking a little stretched right now. You look at small caps. You look at limited floating stock counters. You look at that SME exchange IPO, which we talked about yesterday. Usually, historically, in a situation like this, I think the advice going out to most people is be careful. Would you agree? I know everything is working for us locally and globally, but usually in situations like these, you need one bad news, one negative data point, and that could be local or global. And like I said, I'm not trying to be a wet blanket here. Things could come crashing down, and that's a little bit of a concern. And I feel like at least retail investors need to tread carefully.
No, most certainly, which is why I think we were making that point yesterday as well, that we are probably in a party which is at 1:30 a.m., so dance close to the exit door. Yeah. And the fact that for the last 3-4 days, we've been saying this daily, that the quant indicators are indicating that we are in the extreme greed zone. So caution needs there, but well, for now, global momentum is aiding, so who's to complain?
So this is actually a conversation we had, Samina, on the closing show a couple of days ago, where we asked our experts, what is the filter that you would apply when you are picking stocks? Because everything is rising. You know, there's a saying कि अच्छी ज़मीन हो तो गधे और घोड़े एक समान दौड़ते हैं. But you know which is which. So there's a list of filters. You look at the company, you look at the management, you look at the fundamentals. Go back to the basics.
I think the job of a fund manager has only gotten that much tougher in the last quarter, right? Picking quality, picking value was so much easier 3 months ago. But of course, now with the recent rally, it is a tightrope to walk. Let's quickly take a look at GIFT Nifty so we get a sense of what we are eyeing in terms of opening this morning. It is looking good across the world, like Tamanna and Niraj have indicated. Opening closer to levels of 21,422. So gap up is what we are expecting. This is the implied opening that we should be working on. Well, Asian markets. Okay, I'm going to quickly toss it over to my colleague Tamanna. I believe my mic is rustling at this stage.
Yeah, with that beautiful necklace over there. But you know, while Samina fixes that, some of the stocks that we're talking about today, and Samina is going to address some of the big ones, Jupiter, etc., all the rail pack, which have seen some excitement. I'll just go with the list which is on my radar. Edelweiss is one I want to talk about, and a bit of news there. You had an explanation come in from the management. They have denied allegations of links with the Mahadev app. So now this has become a slightly political kind of a story. There was a statement by the Deputy Chief Minister of Maharashtra, Devendra Fadnavis, who's saying that the probe into the Mahadev app scam is being extended into Maharashtra, and BJP MLA, a prominent BJP politician MLA from Mumbai, Maharashtra, has raised concerns regarding Edelweiss's involvement in that betting app fraud. They've said, the company's come out and said, we have nothing to do with this at all, but a probe will be commenced and an SIT has been formed. So we'll see if the stock reacts to that. I'll just quickly go through the list as well. DRL was on my radar because it's the first Indian pharma company to debut in the DJ Sustainability World Index. And ESG has become top of mind, especially when it comes to foreign fund flows. Remember, when there is global money looking, at asset classes, looking at companies, this is going to be definitely one parameter that is going to be implied. And so that might be some good news for DRL. Ami Organics, and Niraj was talking about it as well, could be an interesting counter to track. They've signed another definitive agreement with a company, a subsidiary called Fermion. This is a subsidiary of a Finland-based company called Orion Corporation, and they will be making 2 additional pharma intermediates for this company. The management says it's going to be a significant contribution to revenue expected to commence by FY25. They haven't given a figure specifically, so that's one. Should we go into Mahindra and Mahindra Financial?
Yeah, just for a bit. Just a small footnote there, when it comes to Fermion, other players, the Naveen, etc., have not been able to yield positive results with their submissions, and out there.
To Fermion.
We've seen AMI get these 2 API approvals, and also an opening of the Ankleshwar unit. So all of that might be a very interesting development. I'm sure Varsha will throw more light on it, but it's a very interesting thing that's happened in AMI.
Yeah. So we'll come to AMI. You want to just
I'll just quickly add in a few stocks that you want to keep an eye out for, and this might be a little more macro in terms of the news flow that we are reacting to this morning. So you've had the railways to green flag about 1 lakh crore train set bids. Remember, the Indian Railways has shocked out a plan to purchase new trains worth about 1 lakh crores. The key beneficiaries that come to my mind immediately are Texmaco and Jupiter Wagons. Both of them have won contracts from the Railway Ministry. Jupiter Wagons has won 4,000 boxes wagons. The contract is valued at 1,617 crores. Texmaco, on the other hand, has won orders worth 1,374 crores. Texmaco, in terms of stock performance, has already done quite well this month. It's up about 26-27%. In the last 1 year, it's up 200 odd percent. So the upside here from these levels may or may not be limited. Jupiter, on the other hand, has not really played out too strongly this month. So if you look at its 1 month returns, the stock is up marginally by 2 to 3 odd percent. Even this year, if I have to be looking at those, actually no, for the year the stock has done well. The last 1 month or so has been soft for the counter. Watch out for both those names. We will see a little bit of a pop-up in early hours of trade on the counter. Another important one that makes news this morning is Adani Enterprise. Israel's Elbit has picked up 44% stake in Adani Defense Systems. The stake is to develop and manufacture autonomous aerial technology. This counter again has been a very big mover in the last couple of weeks. We've been tracking this one closely. So another good, strong, positive news flow will aid well for the counter, and of course would see a big move this Friday as well, Niraj. Coming on Adani, from brokerage reports to stake sales to stake buys.
In the defense space, that's a big one. That's definitely a big one.
Yeah, and just, I mean, for the larger scheme of things for Adani Enterprises may not be as big, but it just shows one more feather in the cap and one more within that within the set of businesses that they have within that holding company structure for Adani Enterprises. So, a disclaimer, of course, Adani Enterprises owns NDTV, and you're watching NDTV Profit. Just a couple of stocks that I want to add to this, and that is, one of them is BHEL, and they've signed an MOU with the Central Manufacturing Technology Institute for Hydrogen Value Chain Development and IIoT solutions for predictive maintenance of machines and manufacturing processes. Now, BHEL traditionally that we knew was a hardcore capital goods company and doing nothing else. In the last 6 months, we've seen this one do some multiple things. Now, this one may not have any financial connotations, so don't quite know if this really reacts too much, but it's an important announcement. If the stock reacts, you should know why it could be reacting. So that's the first disclaimer. Frankly, I don't know if Tamanna or Samina have an insight here, but I don't know if this development materially moves the stock, but it seemed important, so brought it to your notice. And Sterling Wilson, that stock has had a massive run, and then the QIP, so on and so forth, but has received a settlement amount of 254 crores from Jinko Solar over an ongoing dispute. Keep in mind, it about 10 days ago had received one more amount from another firm, again dispute settlement. I think Shapurji Palanji Group had made some amounts available to Sterling Wilson Solar as well. So maybe there is no smoke without fire. This stock has been on a tearaway run in the recent past ahead of the QIP. Let's see if there is more in store for Sterling Wilson as well.
Just a couple of more, if I could add, in interesting companies to what. Genus would be one of them, Genus Power Infra. The unit has got an LOA worth 1,026 crores. So they haven't given the specific breakup of clients or who their customers are on the exchange filing, but they will be providing advanced metering infra services. It's a contract for 10 lakh smart prepaid meters. Now, in the overview of smart cities that the government has, smart meters is a big part of it. So Genus Power Infra is one to look out for. I just also want to add M&M Financial. They are going to be foraying into life, health and general insurance business. They're investing 5 to 10 crores as initial investment towards business diversification. So just a couple of more there. You want to add some more?
We've got a whole barrage of this, and I know we'll cover this as we go along in the show, but lots of brokerage calls as well coming in. So sectors like insurance, you want to watch out for that. that one. Morgan Stanley has of course got a verdict on the latest proposal for insurance companies, the IRDA's proposal. You've also got HSBC on real estate, a couple of buy calls there. So they've got a buy on SOBA, they've got a hold on DLF, and overall realty they've got a reduce on. And you've also got HSBC on Asian Paints, Avenue Supermart, Nestle where they retain their hold, Berger Paints where they've got a buy, Asian Paints where they've got a buy, and Avenue Supermarts where they've got a buy too. Usually stocks like these, and Niraj and Tamanna would agree, react quite sharply to big brokerage calls. So you will see stocks such as insurance names and a couple of the consumer names that will be reacting to these names. SOBA as well on back of a buy call coming in from HSBC.
Yeah, it'll be interesting. The real estate index is at some 12, 13, 14-year highs. None of the stocks are trading at life highs.
Yeah.
It's quite astounding as to what could happen when these stocks finally break out.
I think there's more coming as far as real estate
could be,
is
right?
concerned.
Because the stocks really haven't hit fresh highs. DLF is still multiple miles away from its all-time highs. So also some of the others that were listed. So it'll be interesting to see what happens there.
Data in terms of sales numbers have been very impressive in the last couple of months, right?
Yes.
Of course, it's the upper end of the segment, but nevertheless, real estate is finally, after many, many years, Niraj, getting into a sweet spot.
Just one thing I want to add on the real estate numbers, and I know there's editor's cut which is coming up next. The concentration is still very largely in MMR. All the sales numbers you get is focused on MMR, the Mumbai metropolitan region.
Not really, right? I mean, we've seen
Bengaluru,
South. Yeah.
Bengaluru and MMR. But to really fire, you will need more numbers coming in tier 2 cities. Is my limited point.
No, but sure. But for example, yes. So tier 2, I agree. But otherwise, Shriram Properties sales comments around what's happening in Chennai and around areas, or Max Estates and Anantaraj into the Noida NCR region are also looking rock solid. So, but yeah, point is well taken that tier 2.
The concentration in top 6, top 8 cities needs to spread for this to become a larger secular trend is my limited point.
Sure.
And inventories also do stand at record highs, so that could be a concern. But yeah, we will discuss this maybe on Monday.
On Monday, maybe, yes. For now, let's go across to Alex now to try and understand what's happening on the editor's cut today, because there are a couple of interesting things. We're talking about too much money chasing a few stocks, not all. And of course, there is a lot to ponder over, Alex, because of what the Fed has said and the implications on the Indian side as well.
Certainly. And in fact, for those of you who are tuning in for the first time to the editor's cut, this is where we delve a little deeper into the headline that you might have heard to give you an actionable insight into what could emerge as an opportunity for you on the investment side as well. Now, as Niraj has already pointed out, there is a case of exuberance, one might argue, in certain pockets, and it's a little hard to understand why a lot of money is chasing after a few of these stocks, and I think that Niraj has a strong point to make there. But we will also talk about something that we don't often talk about, and that is fixed income. Is this the time for you to pivot like the central banks are and take a closer look at your fixed income strategy, because this might be a golden opportunity, and we'll tell you why. Samina will help me lay that argument out for you. But let's start, Niraj, with money chasing fast money, as you pointed out.
Yeah, you know, Samina has, for 2 days on a trot, brought out this point of this SME IPO, which has gotten massive monies. But I'll save that for the last. Okay, first a few other points. So Sterling Wilson Solar, we spoke about it getting these order wins. Now, circa 12,000 crores worth of demand for a 1,500 crore QIP. Now, that is large sums of money chasing a stock like Sterling Wilson Solar. Remember, Sterling Wilson Solar, the history, this we are not putting out on air, but the history of Sterling Wilson Solar, that just about a year ago, it was not considered to be the the stock that darling of the street, that people want to chase it so much. And suddenly we're seeing some change of plans. They've met active investors around what to do, and the stock has gotten the kind of demand that it has. So that is Sterling Wilson Solar, the first up off the block. SpiceJet, it was virtually an untouchable airline. Right?
And we have spoken in the recent past, Niraj, 89% of the market controlled by two entities.
Two entities, right? Which is Interglobe and Air India, right? SpiceJet gets 2,200 crore rupees. Yes, there was an absence of marquee names because it was believed that, maybe a very large prominent world global fund will come in, or a large other airline person will come in. That didn't happen, but it got the money.
Yes.
Yeah, and sure, the stock has come off from the recent highs, but it got serious amount of money. J&K Bank, the QIP, saw a demand of over 20 times. You know, we were thinking that a QIP happening at a 10% discount will see the stock come off. The stock was up 9% that day simply because of the health of the demand. And then the SME IPO. Yeah. 18,891 crores worth of bids for a 78 crore IPO. Guys, there's just a serious amount of money chasing a few ideas, and I think there's a rumor. Sorry, just one last one. There's a talk. I know you want to come in on the SME IPO.
Go on, you finish.
No, I'm just saying that there are a few QIPs that are slated to happen if Grapevine has to be believed. It will be very interesting to see what's happening to those block trades or those QIPs over the course of the next 15 days.
You know, Niraj, while you mentioned that this euphoria continues, I still remember exactly about a year and a half ago, everyone was talking about how easy money is going to stop because valuations were going, you know, there were financials that were getting valuation at 10, 15x. Tech companies, let's not even talk about what they were getting, right? And there was a general sense that this era had ended and was taking a break for the next few years, right? But from what we are seeing right now, I don't know where this money is coming from anymore because the euphoria doesn't end.
Maybe the funding winter in the startup space is moving to the secondary markets.
Also, the market is preempting that if we are looking at a rate cut cycle, then let's look at EMs, which will benefit. Okay, EMs, which are the EMs? BRICS. You look at Brazil, India, Russia, China. You look at India probably looking like a bed of roses relative to everything else.
But is it really FII? Is it foreign? It's not necessary.
No, I'm just saying, so at large, en masse, there is this global money coming in. And then local money, right? We've spoken about how the local SIPs, you know, we speak about local SIPs so regularly. We don't talk about the kind of money that is coming into the PMS and the AIFs, right? Samina has great insight there, but just the quantum of AUM has jumped up.
On that note, the likes of a Unify have stopped receiving fresh money.
Yes, a lot of them have.
Huge, right? Now, whether or not this is because they've got a mutual fund license coming or they don't have ideas, because at the end of the day, a PMS is supposed to be more concentrated strategy. But yeah, they've actually said no more fresh flows.
And interesting, I remember this in a chat that you were doing recently where the manager said that we have received funds, but we have the leeway to hold for a period of a couple of months before we deploy completely, and we're utilizing that leeway.
Yeah, I think that was Rishabh Sheth of Pharma.
PMSs usually do that, right? AIFs and PMSs have the ability to sit on cash before they SIP or STP their investments. But yeah, the euphoria is here to stay, I'd like to believe.
So, just the size.
Sorry, what's the bottom line according to you, though?
No, so the bottom line is just this, that for now, I mean, we've been talking about it on the trade setup every day, that the party is looking stretched, but at some point of time, these are cautionary signs. This has happened umpteen number of times in the past. Once the market corrects, which it eventually will, everybody will say that, hey, these were telltale signs. Yeah. But until it hits,
it's always the hardest point. I mean, of course, it's the hardest point to...
You can't time the top,
You can't time the
top.
But
these are slightly discomforting signs, you have to be honest.
Fair point. All right. So, but on that note, and I think this leads very nicely into our next chat, which is on fixed income, because generally, from a personal finance standpoint, you would say you book from equity and you push into fixed income. I would argue, Samina, that this is a golden window for you to put money into fixed income. And if you're talking about bonds, right, because it works this way. If the interest rates go down, prices are going to go up for existing bonds. And if you buy early, you get the benefit of that price appreciation. And if you can lock your yields in right now at around 7.5%, 7.6% for a few, target maturity funds, which allow you to hold to maturity if you do want to do that, you have the potential in the next 3 years of maybe getting that capital appreciation as well.
So just to quickly comment on that, right, and talking about euphoria, historically, debt is supposed to be a risk management tool for stable investments. If you want alpha, you go after equity. If you want safety, you want, your portfolio being comforted, you look at debt. But with the euphoria around, we're now even discussing investing in debt because the timing is correct. Debt has never been about timing it, right? But just to comment on your point, and let's break this down. Rates have peaked. Liquidity is tight, so we aren't expecting any OMOs coming through. Rates, after what we saw in the Federal Reserve meet that happened recently, the anticipation is that India will cut rates. Now, whether they do it over the next 6-month period or they do it over the next 1 or 2 years is anybody's guess, right? But cuts are coming, which also means that we've peaked on our current tenure. Now, if I have to break this down, while you said yield is, so the two ways to make money on debt investments is either through
interest rate
yield or through your M2M, which is a capital appreciation. Yeah. If you hold to maturity, the only return you're yielding is your yield.
Correct.
This instrument where you're trying to trade a debt income debt as an asset class for the short to medium term also means that you've got to time it, enter today and exit it over the next couple of months or the next 1 year once rates start coming off. All of this depends on how sensitive your portfolio is as well, right? Yeah. So if I've got a medium-term duration portfolio with a 5-year maturity, and I'm just going to break this down for the sake of our viewers, where your paper is 5 years, rates come off by, say, 1% in the next 1 year. Yeah. I've entered at 7, rates stand at 6%.
Yes.
Which means what I do a year later, if I want to exit this asset class, my take-home returns on that is 14% pre-tax. Right. Now, that's a really sweet spot to be in. But the other critical angle to watch out for is if you enter debt as an asset class, there's always a reinvestment risk.
Yeah.
You enter at 7, you get out at 6. What happens then with that money, right?
That's a very
Are you going to move it to equity? That's the question to ask. If you're going to stay in debt, you're locking in your yield at 6% now.
But that's a sweet problem to have. Let me get the returns first, then I'll think what to do with it.
But it's a fair point from a personal finance planning perspective, Niraj, one would argue.
Because your objective is, Niraj.
Because you plan, yeah, exactly. So you plan saying that I can lock in 7.6%
for
now.
For the next 10 years.
For the next 7 years.
Yes, but it's good to have that option, right? That I've locked in my rates,
which is my argument.
14%, and if I have the option,
which is my argument.
Why not? If I'm getting the money,
it's win-win. It's win-win because
it's a sweet spot.
If you're uncertain,
if your risk profile is high or moderate to high, I would say you could look at a long duration paper.
Absolutely.
If you are conservative, so I think somebody wants to draw the middle line or the middle ground, medium-term paper looks good. So your 4 to 5 year sensitivity, so which really means that your underlying is in the range of 5 to 6, 7 years maybe. In a case like that, rates will come off. You make your M2M, which is capital appreciation, and then you have your yields. Another thing to note is post the budget, taxation is
I was
your
going to point that
tax
out.
rate.
Yeah. So very quickly, for those of you who aren't familiar with this, and this is the closing point, if you are looking at investments into fixed income mutual funds, all of the gains from that are now treated as short-term capital gains after the change earlier in the year, and you will be taxed at the slab rate. Now, this is basically bringing these products on par with a lot of other fixed income products like fixed deposits, and so therefore the benefit that was being received by fixed income mutual funds no longer exists. But the argument is that you can make money on the interest rates and potentially on capital gains as well. We will hold this conversation for later when we perhaps do the mutual fund show, and we'll get you actionable insight if you intend to deploy into fixed income mutual funds. But then for now, we have to slip into a very quick break and set you up for the day's trade. So do stay tuned.
watching the India Market Open, and let's take a look at the top headlines at this hour before we move ahead. The post-Fed rally continues on Wall Street. Dow and Nasdaq power ahead to hit new record highs. Oil prices rebound after surging 3% on weaker US dollar, and gold prices also continue to rise. Back home, after a stellar rally, the question is, will Nifty and the Sensex stay on course to end the week with strong gains? We'll find out in a bit. And Adani companies will again be in focus today as the group plans to invest 8,700 crore rupees in Bihar, which will create about 10,000 jobs. On the macro front, wholesale price index-based inflation turns positive after 7 months in November. WPI inflation stands at 0.26%, driven by a sharp increase in food prices. All right, let's take a quick look at the GIFT Nifty before we move ahead to set the stage for futures and options this morning. And GIFT Nifty, yes, staying well above where the cash market ended yesterday. So we'll have to see whether we see another morning of positive openings and a gap up. But meanwhile, Agam is joining us with what the cues look like on the derivative side of things.
Right, Tamanna, you know, a lot of things have changed after the Federal Reserve, and because of that, a lot of technicals in our own markets have also seen a little bit of a shift upwards. Now, before yesterday, we had a lot of resistance around the 21,000 mark. That's actually been taken away comfortably, and at the moment, we are sitting nearly at around 200 points higher than that particular level. For now, of course, a whopping 18.5% increase in open interest towards fresh longs, and because of the fact that these longs have been so much higher, well, we're going to have to wait and watch whether or not there will, in fact, be a little bit of profit taking, if not today, then over the course of the next few weeks. Before I move in, a very quick pointer. We have seen the Nifty Relative Strength Index stay above the mark of 70 for 2 straight weeks. Now, that I don't remember the last time we have, in fact, seen the Nifty remain above the mark of 70 for so long. So it does also show that there's some overheating as far as some of your technical indicators go. This is as far as the Nifty is concerned. It's when it comes to the Bank Nifty too, well, strength remains with another 1.5% increase as far as your underlying goes, and unwinding in open interest. Coming down to where the Nifty options lie at the moment, now we must remember that until day before, it was a 21,000 call, which was the one with the maximum open interest. That has been completely removed from the picture, and we are now starting to see a lot more traction around higher levels. In fact, it is 21,500 call, which now does have a maximum open interest, and that will potentially provide a little bit of resistance on the higher end. And on the lower end, of course, we're looking at a lot more action around puts. So, and all those puts also well over the 21,000 mark. So clearly the range has also shifted higher. Coming down to the stocks, and yesterday we did see a lot more longs building in SAIL, Manappuram Finance, along with Exide, and ICICI Prudential and PI Industries under a little bit of pressure. In terms of stocks, we saw unwinding. Well, we did see short covering in Nalco and SBI Life and GMR Airport, along with Dr. Reddy's, seeing some amount of longs unwinding. On the other hand, of course, we are also seeing M&M, which did see about a short covering. But that said, when it comes to the benchmarks, and that is where the focus will be, can we expect a little bit of temperance? Well, let's take this up with the expert for today. And we have Jay Patel of Investmentor Securities, who's joining us on the show. Jay, good morning, and thank you so much for joining in. Let's start with your assessment of the benchmarks. What would you do with them, and how would you employ options, perhaps, in terms of strategy?
So good morning, Agam, and good morning, everyone. So today we saw Nifty will open up with gap up opening more than 21,200 data. I believe yesterday we saw a long build up on particularly Nifty December's future. So with 1.3% upside and with OI addition of more than 18%, we saw long build up massively in particularly Nifty, and Bank Nifty witnessed a short covering in yesterday's trade. Particularly, I am very cautious regarding Nifty's move because, as you say, technicals are little overrated, and particularly RSI plus PCR data, that is 1.2 for Nifty, they seem to be overrated, and I believe today or maybe in the Monday session we can see profit booking scenario to come in, but I don't expect to fall Nifty to fall to less than 21,100 levels. Although I believe the range can be around 21,050 to 21,250 for the today's or maybe tomorrow's session, that is on Monday. So for the next week, as you said, I'm pretty sure market would reach a new all-time high, particularly 21,500 level. We can see as an intraday high, particularly next week. Or as option data and open interest data suggests, there is strong OI addition, particularly in 21,500 open interest, and particularly 22,000 also saw a massive open interest data addition in yesterday's session. So I'm very bullish on Nifty particularly, but 1 or 2 days we can see a profit booking scenario to come in, and we can see time correction maybe at these levels.
Jay, are you placing an option strategy here, of course, with the kind of levels that you've given us right now?
So particularly that being said, I expect individual stocks to perform well. Thereby, I'm very bullish on the AU Bank, particularly after yesterday's massive rally. We saw banking sector to coming in very strong base. AU Bank 760 call option for 20th December. I believe we can see strong OI addition, plus the price can rise very steeply. Currently, it is trading at 20 zones. We can expect the option to rise to around 30 to 32 levels with a stop loss of 12. As you see, yesterday's AU Bank has given a strong breakout above its moving averages. Plus, we saw a strong volume coming in this stock. So I expect it to rise deeply, particularly in AU Bank. And the second would be M&M Financials. M&M Financial 290 call option. I'm very bullish about that, and we can see it ended around at 11 zones. Particularly, I can see the this stock move very fast, and we can see momentum coming in today, particularly after the breakout above its 200-day exponential moving average. So at M&M, we can expect a target of around 20 zones for the call option of 290 strike price, and with a stop loss of 4 to 5 rupees. So M&M and especially AU Bank, I'm bullish on both of these NBFC and banking sector stock.
Right. Of course, both these strategies that Jay has mentioned are naked long positions, and naturally this is to take advantage of the sharp moves expected on both these counters, and that's the reason why Jay is not giving you a counter, a call or a put. They're just saying plain vanilla calls, go ahead and buy them. And of course, you take advantage of the quick movements in both these counters, which are expected by Jay. Jay, on that note, we're going to thank you for taking us through your views on the markets, as well as giving us your views here. And on that note, handing it over back to you all.
Thank you, Agam. That's the complete update coming in on the F&O picture and stock trading ideas from our guest as well. It's looking like a good start. Like we've indicated, Asian markets are cheering. Indian equity markets also set to open up on a strong footing this morning. One sector that will be in focus will be railway stocks, as Indian Railways is all set to buy trains worth 1 lakh crore rupees. My colleague Mahima is standing by with more details on that. Mahima, what is the news flow that we're tracking, and what does this mean for the 2-3 major railway players?
Right, Samina. So if, like you rightly said, that the Indian Railways set to purchase new trains worth rupees 1 lakh crores. Now, if you see, as per the current budget that was allocated to them, 70% has been already allocated, and it has already been used. So going forward, this will replace the 1 lakh crore that is used, will be replaced, will be used to replace the old aged trains that are rolling currently, and 7,000 to 8,000 new train sets will be needed for this. The tenders will be floated in the next 4 to 5 years, and this needs to be completed in the next 15 years. The investment target that is set by the Railway Ministry for 2030 is approximately 12 lakh crores. And if you see the current achievements of the Indian Railways, the completion of Eastern Freight Corridor has been completely completed, and it is catalyzing the development of new industrial areas around the Eastern Corridor, and the Western Corridor is also 80% complete. So this looks very good for the Railway Ministry. And if you see, currently there are approximately 10,754 daily train trips, and 3,000 more need to be added in order to cater the current waiting list that is being there. The target for the current fiscal year is to be set at 5,500 to 6,000 kilometers of new tracks will be set. If you talk about the order wins, the stocks that will be on the radar today will be first one being Texmaco Rail, where the Texmaco Rail received an order from Railway Ministry for manufacturing of 3,400 Volkswagens for 1,374 crores. And the second one is Jupiter Wagons, where Jupiter Wagon has also secured an order for Railway Ministry for 4,000 Volkswagens for a contract value of 1,617 crores. So these are the two main key stocks to watch out for today in terms of railway stocks.
Okay, well, thanks a lot for that. So, railways is interesting simply because of the fact that the outlay seems to be very large and they are consistently winning orders. Also, the other interesting thing, guys, is what Titagarh Wagons had told us when we had visited their plant, wherein they're saying that until now we are making coaches or wagons, whatever. Now we want to get into backward integration, so they tie up with Ramkrishna Forgings for making wheels in India, because otherwise they were imported. And then he indicated how these lightning fuses, etc., and they want to get into the manufacture of all of those as well, because hitherto they are buying it from other vendors. So the whole ecosystem gets developed for each of these companies, and I'm sure Titagarh is not the only one who's thinking about it. So the large outlay for coaches, and within coaches, the ecosystem or the stuff that is ancillaries that is there, they will get into, some of these will get into manufacture of some of those, and just imagine the breadth of business that comes into for these railway players.
On that point, even stocks like an IRCTC, if you're expecting business to pick up, railway usage to go up, all these stocks, apart from your BEML, IRCTC, all these are stocks that will be something to watch out for. So while order wins are happening on one side, I think the commentary from the rail minister is what could change and it usually happens pre-budget. That's the other thing that's...
So I would just widen the horizon of the conversation in IRCTC, obviously, because they want to cater to more than just the railway. So that's exciting. But the idea, the overall vision is to make the Indian railways faster and more accessible and more desirable for passengers. I just want to add context about the number of passengers who have, because of relatively cheaper and affordable flights, moved away. The big picture is to make this now an upgraded transport system, which hasn't really changed since pre-independence time. So the volume is going to increase multifold. The question is going to be whether you have enough companies with the capability to do the work that is waiting in the wings. It's going to be the reverse problem.
And it's very true, because remember when the World Cup finals happened, most people actually used the train. Now, this is something we haven't seen historically, right? You had air flyers, they were insanely priced.
When we're talking about airports looking good, I must say the railway stations, you follow the rail minister on Twitter, he puts out these tweets about guess where this railway station is. You'll be amazed at what's happening in India. It's quite stunning, really. But, okay, so that's railways and lots of it. We'll talk to our guest about it as well. But, okay, I think we have our guest, and in a bit we'll get in Varsha to talk about some of the others. But since we moved on to stocks and news, let me get in Sudeep Shah, Deputy VP and Head of Tech and Derivative Research at SBICAP Securities, on the show to talk about, well, technicals and derivatives. And Sudeep, great having you. Thanks for taking the time out. Before we move to the market at large, we are out here in the studio talking about what railways are doing, what's happening to those businesses. And it's not just Titagarh, Texmaco, Jupiter Wagons. There's also the locomotive manufacturer BEML. There is also Alstom and some of the others, global players out there too. So it's a wide bucket. Have you had a chance to look at this pocket recently? Do you like or dislike any of these names?
Good morning, Niraj and everyone. And see, what I feel is that I was just hearing your conversation since last 5-7 minutes on the railways, and it's absolutely bang on, because you've seen in the last several months the railway minister coming out and speaking about the modernization, upgradation, and the focus of the government on the railways and how to improve it going forward also, and getting it to the standards equivalent to the air traveling. So I feel there's a long way to go, and that is the reason why all these railway stocks, even at higher levels, are witnessing a good accumulation and a good interest. So a lot of these stocks, Texmeco, BEML, or you say Ircon, RVNL, Railtel, IRCTC, you name it, and all these stocks, they are moving in tandem. It's just not one or two stocks, it's the entire pack that is moving, and that is what is giving us more confidence that even in this is a structural story, and this could continue going ahead also. So, and our top pick within this space would be Railtel now. Technically, this stock has given a consolidation breakout at higher levels. Since last 15-20 sessions, the stock has been consolidating between 280 and 295. And yesterday, the stock has given a breakout with higher volumes. And on a breakout day, when there are above average volumes, that gives you a sense of confirmation and a sense of calm that this stock is really heading on the way up. So I feel that this particular stock, Railtel, is extremely positive on all the time frames and trading above its key moving averages. So from the current levels, this stock could be bought with a stop loss of around 290 and a target of closer to 320, 325 on the upside.
Sudeep, good morning. Stay on with us. A lot to discuss this morning. When there's so much news flowing in, a lot about it focused on new orders, MOUs, LOAs. So a lot of business coming in, but I just want to quickly go across to my colleague Varsha from the research desk, who's got a list of the top stocks to watch today. Varsha.
Good morning. So let's start with Adani Enterprises, where Elbit Systems has picked up almost 44% stake in Adani Defense System and Technology. Now, this unit is to develop, manufacture various autonomous aerial technologies and systems for defense application. Now, Adani Defense System had signed a shareholder agreement with Elbit Systems for 44% stake in Atharva Advanced Systems. Elbit Systems subscribed to almost 7,857 equity shares, which were issued by Atharva Advanced Systems. Now, as of today, Adani Defense System and ESL now owns almost 56% and 44% respectively of Atharva Advanced System. Then we have Bharat Heavy Electricals, which signs new MOU to collaborate with Central Manufacturing Technology Institute. Now this is to develop technology in areas of hydrogen value chain and IIoT solutions. Now this technology is for preventive maintenance of machines and manufacturing processes. Then we have IRB Infrastructure Developers, where the trust emerges as preferred bidder for tolling, operation, maintenance of Kota Bypass and Cable Stay Bridge. Now, the trust is to pay upfront concession fee of almost 1,683 crores to NHAI, and the project will add almost 1,800 crores to the order book of IRB. Then lastly, we have AMI Organics, where it has signed another agreement with Fermion, which is a subsidiary of Orion Corporation in Finland. Now, company will manufacture 2 additional advanced pharmaceutical intermediate for Fermion. Now, this will be used in captive consumption as for already signed 2 agreements in November 22 and September 23. So whole set of contracts with Fermion. Now manufacturing will be taking place in Ankleshwar facility. Now this will add significant contribution to AMI Organics FY25 numbers. And important thing is that the whole set of Fermion deal is a multi-million dollars deal, and this will be the growth trigger for AMI Organics in FY25.
For that, Varsha there with all the top stocks to watch. I also want to welcome Vinit Bolinjkar this morning. He's HOR Ventura Securities. Vinit, and great to speak to you as well. Sudeep also with us. Sudeep, just before we move to some of the specific stocks that Varsha has been talking about, we've been talking about all morning, and lots of stock-specific news. I just want to get your view on the indices and on the levels there. So we had, again, we're in blue sky territory right now as far as the Nifty and the Sensex is concerned. So what is the kind of range you're looking at?
Pretty well put. We are in a blue sky scenario, and it's tough to speak or call about resistances. So I feel in such markets, it is much better if we just try to gauge supports. Whenever there is a dip towards those support zone, just go long, because there is no way one could think of even going short until and unless we see the trend weakening or we see some kind of a reversal. So from the current levels, if we see yesterday, there was a massive long build up in Nifty futures, while there was short covering in Bank Nifty. But Bank Nifty, specifically coming to Bank Nifty, what has happened is that there was a resistance around 47,300, 47,400, which was created in the last 4 or 5 days. And with this gap up, with this entire gap up yesterday, and Bank Nifty sustaining above this 47,500 levels, there was a lot of call short covering that was visible yesterday, and fresh put writing was also witnessed. So I feel Bank Nifty 47,400, 47,500 levels would act as a strong support. And with the kind of momentum that we are seeing in ICICI Bank, HDFC Bank, even Kotak Bank showed some good signs yesterday. So I feel the Bank Nifty is headed up to 48,200, 48,300 in the next few sessions. And coming back to Nifty, with the kind of support that IT has provided yesterday, Nifty IT yesterday has given a breakout above this zone of 34,100. And remember, there was a gap in April 2022 there, and that gap has now been closed. So I feel Nifty IT is now headed up to 35,000, 35,300 with a lot of strong momentum into Infosys and all these top stocks. So with the support of Nifty IT, now Nifty could very well inch up to 21,350, 21,430 in the next few sessions, with supports placed at 21,050, 21,100 on the downside.
Quick follow-up there, Sudeep. You're looking at a gap up today, or do you see some kind of a Friday breather?
No, there could be a 50-60 point gap up is not ruled out.
Okay.
But I feel a 50-point gap up, but it could sustain somewhere here only. We could see some kind of a consolidation at higher levels, because the RSI is now overbought and a lot of indicators now need to cool off. So we might see some consolidation before the next leg of the up move.
We're going into the weekend as well, so I think traders will want to go into the weekend fairly light after the activity that we've seen on the street in the last few weeks. Vinit, good morning. This is Samina from NDTV Profit. It's been a while since we last chatted, but I believe you're quite constructive on the markets currently. How do you feel? Do you feel like we're seeing some tiredness, some lethargy that's kicking in? This is one of those rare Decembers where the euphoria is very obvious to see. Money is all over the place, chasing quality, chasing cheap, not so good equity. How are you feeling at this stage? Are you a buyer? Are you going to stay on the sidelines? What is it that you're telling your clients?
So we are not going to stay on the sidelines. It's very simple that, in the US, money printing is not going to stop till 2025. And if you go by that measure, we are going to see some endless printing happen. Caution is thrown to the wind. You have the elections in the end of 24 in the US. So I think we are going to see some phenomenal liquidity globally. And with India being a top performing market, and a lot of FOMO among international investors, we are going to see them piling big time into the Indian equities, and hence we are going to see a very large move happening in the months of January as well as continuing into February.
Right. Vinit, just, in terms of what you're liking right now in themes, are you still excited about IT? You think more of a run-up and a play expected there? IT, auto as broad themes, and real estate. Just a quick word from you on these three.
So IT, along with a word of caution, more of a momentum play. Yeah. Real estate, very, very constructive. And on autos, two-wheelers over four-wheelers.
Chair, Sudeep, what is your take on some of these real estate names? Stocks like Soba have brokerage buy calls coming in this morning. Would you look at adding or maybe, strategizing again around some of these real estate counters today?
Before moving on to stock-specific names, just let's see how the Nifty Realty Index has shaped up. Now, this index has been on a tear from, say, October 2023's low of 559. Now, it's almost 35% return on an index basis. And in the last 7-8 sessions, excluding yesterday's session, there was a consolidation that we had witnessed in 8 sessions, at least. And yesterday, post this consolidation, there was a big breakout. So, I feel Shobha is a decent pick at this current levels, but more than that, I would be much inclined to chase momentum, and momentum is there in Godrej Properties. Yesterday, we saw a big breakout on the upside. The stock surged by around 6-7% with a rise in open interest. The stock is now trading above all its highest level, and it's trading at its say post Jan 2022's highs. So it's almost 2024 or 23 months breakout, and I feel the stock is headed on the upside up to 2200, 2230 with supports placed at 1980. And apart from that, even stocks like say Prestige Estates, DLF, they are also looking good from current levels, and there's a multi-month breakout there also.
Very short break, but hold that thought. We're coming back with an interesting report. There's a slew of brokerage reports this morning on what is happening to the insurance companies. Just a quick precursor there. The RDI has put out a recommendatory note for the cap on what happens if you want to surrender your policy in advance. And the surrender penalty has been capped. It's been seen as negative for insurance companies. What are brokerages saying? We're talking about that after this break. Don't go away.
Right, 30 seconds left for the markets to kickstart trade. Samina is out, do a wager with me on what the markets will do today. I'm not an expert here, but just for kicks, Samina, I'm saying that we'll still end in the green today.
In today's day of
Take it with buckets of salt. I don't think any of us can predict what the markets will do.
No, Niraj, but look at it. It's just... It looks tired, right? We've seen data that's proving it's tired.
Let's see.
Of course, the problem this morning is Asia is looking great again. So I don't know how that plays out.
That's a good problem to have
for the street.
The pre-open rates.
Clearly, we are on the bullish side.
Okay, the pre-open rates kicking in. And let's see how they start off. Remember, the SGX was indicating a start which is 70, 80 points in the green. Let's see if we indeed start off about that much levels for the Nifty. This will be all over the place, so let's give them a chance to settle down. The Nifty and the Sensex also showing divergent trends. Let's wait and watch if these rates change. Keep an eye out for the currency because that showed a bit of strength. Yields had come off a little bit. Can we do more of that? I think that's the key question. Now, we're in conversation with Sudeep, Shah and Vinit Bolinjkar. Vinit, good morning. Niraj here. I'm getting down to a specific pocket and a specific stock. If you don't have a coverage on AMI Organics, I would love to understand what you think about the spec chem space at large. But AMI Organics in particular, if you have coverage there, this morning they have come out with this announcement of an Ankleshwar facility, of doing another contract with Fermion for APIs, and that's remarkable because a lot of other people have failed doing so. Do you track AMI, and what is your view there? And what's the view on spec chem at large currently?
So we don't have coverage on AMI, but I have, had brief conversations with the management and extremely positive on their capabilities. So when Fermion ties up with you, you give them a lot of respect. And I think this stock is going to move places. So this is definitely a stock on the radar and to be kept in watch.
Okay. Do valuations play a spoil spot? Sorry, I don't know if you have active coverage there, Vinit. So excuse me.
So we don't have active coverage. We've done some work on that.
Okay.
But the valuations. See, you can't buy any organics based on valuations. You have to go deep, understand what they do, understand the business, and then pick it up.
Just a quick, just to polish off the conversation on spec chem. Sudeep, come in on some of the other stocks which have done very well of late. The Aarti Group stocks, for example, within the spec chem space, and Aarti Industries, Valiant Organics, both of them had a bit of a run-up. We've seen a couple of other stocks do well. Anything out there in that bucket that looks good for a trade?
Niraj, if you see Aarti Industries now, this stock was in a big downtrend. The stock was in a downtrend since October 2021. But I feel that this downtrend has ended somewhere in the first or second week of November, when the stock has managed to cross and close above its 200 DMA for the first time, probably after May 2022. So now the stock is slowly building up gains. But since we are not seeing much of a traction in almost most of these names, as well as the chemical names overall, so that is the reason that we are not seeing a big bang move on the upside. But definitely these stocks are slowly and steadily coming out of its downtrend, and it would be very soon that we see a structural uptrend beginning into these names also. But since the markets are right now focusing on a lot of other themes, I feel when the markets will cool off, then this particular segment, this particular sector will start picking up like it did a couple of years back.
Just stay on with us. I want to go across to my colleague Pragati, because Morgan Stanley, Nomura and Jefferies have come out with a note each on insurers after IRDA's latest proposed changes to the current calculation for surrender value. Pragati is giving us the highlights of those notes. Pragati, what is the outlook?
Hi Tamanna, very good morning to you. You're absolutely right. The notes have come out and it's primarily a consultation paper as of now, but the idea is that if the proposal gets passed, and the broader consensus that we are picking up at this point is that if the proposal gets passed, it might have some negative impact on the companies, but might be something positive for the customers. Of the three brokerages that I'm picking up, and I'm going to run them by you one by one, Jefferies is saying that the new concept of threshold premium may raise the surrender values, but it might also trim the fee for the insurers. Now, if we look at the fee aspect and from the insurers aspect, it may also offset some impact by lowering the cost. Jefferies has to also say that overall, if we see, the proposal is going to be about 40 to 45% of the APE and the VNBs as well, which is the annual premium equivalent and the value of new business. So it can be largely an overhang if the final proposal gets passed. If you look at Morgan Stanley on the insurers, Morgan Stanley has to say that defining the threshold value as a percentage of total premiums could be a mitigating option as well. So there's a likelihood that the industry could use clawback clauses for the commissions that are paid. And while there is some negative impact on the insurers, Morgan Stanley has to say that it is a positive move for the customers, as it could encourage them to enter the insurance space, have insurance policies for themselves, because till now, if we were seeing, the coverage was very less in terms of people. Lastly, what Nomura has to say that this particular proposal, if it gets passed, could lead to higher surrender values as well and lower VNB margins for the non-linked insurance products. But the interesting bit here is that Nomura has also pointed out that the maximum impact of this proposal, if it gets passed, is likely to be seen on Max Life and HDFC Life. And if we have to look at SBI Life, which is another major player in this segment, it will likely be insulated. So largely it's still a consultation paper, but if the proposal gets passed, these are the likely impacts on this.
With that.
Yes, absolutely. And we saw HDFC Life really feeling the pinch also over the last few days. Okay, I'm just going to get a quick word in from Vinit Bolinjkar. Whether the impact or expected impact was overstated yesterday in trade, Vinit. And would you see a rebound, or do you think this is going to be a huge issue? I mean, what proportions of policies are actually surrendered? And, how much is coming in from those penalties then is the question, isn't it?
Yeah, so, my opinion is that we will see the markets move back up again because, the trend towards surrender is going to sort of come down, if I may say so, because people are getting more savvy about, having understood that life insurance is a necessity more than an option. And given these trends, I think that it is overdone as of yesterday. We will maybe move sideways for a couple of days, but after that, we will see it spike up as we resume trading from next week.
Would you like to buy any of these insurance names, hoping for a little bit of a pullback?
I would like to buy SBI Life.
And you would buy that in opening?
No, I would wait out for the day. It would be like a BTSC kind of trade. Another stock that we like is Religare. So these are couple of stocks that I would be venturing.
Right. SBI Life and Religare, that's a fundamental call coming from Vinit. Sudeep, what about you? Would you play any of those insurance counters this morning, betting on a pullback in intraday?
Not at least at the beginning of the markets, I would like to see how the price action is shaping up throughout the day. But if I have to choose anyone out of all these names, it would be HDFC Life, because in the last few days, the stock has given a breakout on the daily and the weekly charts as per the price action, and if we even track the derivative data. But it was just yesterday's day when the stock could not sustain at higher levels. But overall, it is still trading above its consolidation range, the range that it was into since July 2023. And the breakout had happened in early December. So it's just about to retest that consolidation breakout zone. And I feel overall, till the time HDFC Life stays above 668, 670 zone, from a positional perspective, the stock is still bullish. So in the second half, if the price action is positive and if the stock sustains above 695 kind of levels, then I feel this stock should be looked upon from a positional perspective.
Okay, pre-open rates have settled, and just mark what the Nifty and the Sensex are doing or likely to do on open. Well, about 100 odd points, so actually better than what the SGX was indicating as well. So that's to be kept in mind. And just bring up Nifty IT or the IT stocks, because those were the ones that really shone in trade yesterday. Well, about 0.5%. TCS maybe marginally lower. Pull up Infosys, pull up HCL Tech as well as Tech Mahindra. And of course, the broader end of the spectrum had Emphasis, Coforge, and some of the likes doing really well. So IT should be kept in focus today. And of course, aside of that, Adani Enterprises and the railway stocks at the broader end of the spectrum. Adani not at the broader end of the spectrum, it's a Nifty stock, but the railway stocks at the broader end of the spectrum should certainly come up on your screen. Just see what they are doing. Jupiter Wagons 3%, Texmaco Rail 5.5%, 180 currently, really strong show. We slip into a very quick break. Back with some top ideas from our experts.
back. You're watching India Market Open. It's looking like a good start to this Friday morning. Broader markets also expected to open positive. Sudeep, we've got 2 minutes to go as we gear up for trade. Can you take us through your top trades for the day, and if you've got any sort of view on the IT pack, anything in the IT sector that you'd look to buy?
Coming to the top picks, the first top pick is from the metal space. Now we've seen a big breakout in the metal index, and largely it has to do with the cooling off of the dollar index. So the first pick would be Nalco, National Aluminium. Now yesterday we have seen massive short covering in this counter, and today the stock is opening with an upside gap, and I feel that this up move in Nalco has just begun. The stock has given a downward sloping trendline breakout yesterday, backed with above average volumes, and right now it is trading above its all key major moving averages on the daily, weekly charts. So I feel from the current levels, Nalco can be bought with 102 as a stop loss and 114 as a target, 114, 116 as a target on the upside. From the IT space, if we see Tech Mahindra and Infosys are my top picks, and coming to Infosys, the stock has given a breakout. Say it's with today's opening, it is right now opening above its previous swing highs of 18th September, and I feel from the current levels, the stock is headed up to 1560, 1570 zone, and the stop loss for the same could be around 1490 on the downside.
Okay, well, stay on, gentlemen. About 15 seconds left for the markets to kickstart trade. Some optimism out there on IT. Interestingly, banking is not featuring in too many buy calls on the trading side. But let's see what's happening to some individual newsmakers as well. But first, the markets. And here's how we start off this Friday morning. Up about 0.5%, 100 odd points, 21278. So really strong start. You have to admit, after a number of days that we've had an uptick. Sensex about 0.4%, the Nifty Bank also around those same lines. I'll be interested in seeing what Nifty IT is doing. Okay, mid cap 50, about 0.5%. Great going. Small caps and Nifty IT should come up on your screen once. Nifty IT better than what the Nifty and the Bank Nifty are doing. And the small cap index then about 0.64%. So the momentum continues there. Let's get the heat map up on the screen and show you what's moving on the index first. It's a day of green. Let me start with the winners. Hindalco yet again doing well. Tata Steel, JSW Steel. So metals are having a good run. You have to admit, maybe the dollar index correction, maybe the Chinese stimulus stocks, but something's got into metals the last few days. They're doing well. Infosys is your top gainer on the IT side, 1.6% in fact. There's strength in HCL Tech and Wipro, so those two are doing okay too. But a lot of green, which is a good part. Very little red. HDFC Life continues to sulk, but it's and Bharti has a cut to underweight from Morgan Stanley. So maybe those two have some reasons. Power Grid also continues to sulk, but it's a day that belongs to the gainers. Infi now up 2%, and metals, well, there is Metallica at play here, Tamanna.
Absolutely. You know, I like these word of the days, and today for the markets, the word of the day is stamina. This market is not getting tired after what is looking like a marathon 6 weeks, but also a spectacular week. But what are the stocks we should focus on, which had some great news flow, interesting news flow that we picked up even before market started? Let me start with BHEL. So they've signed a MOU with the Central Manufacturing Technology Institute value chain for hydrogen value chain development. I'm looking at this company also because it's playing into the larger infra theme and play. M&M Financial, another one on the radar this morning, even when insurance companies are otherwise feeling the pain because they're going to foray into life, health and general insurance. As for M&M Finance, let's talk about the railway stocks, which were buzzing even in pre-open trade. Texmaco Rail and Jupiter Wagons. So this is the government putting forth a very huge rail upgrade budget, and Texmaco has got about 1,400 odd crores from the Railway Ministry for manufacture and supply of box and wagons. Jupiter Wagons has received an order of 1,600 crores as well from the Ministry of Railways. Wow, look at Texmaco this morning. 9% up, Jupiter about 4% up in trade. Sterling and Wilson is another one. A bit of news has come in just pre-open as well as far as Sterling and Wilson is concerned. So earlier, of course, they got a settlement of about 250 crores from Jinko, which was good. But they've also put out a release talking about raising 1,500 crores through QIP, and Sterling and Wilson up 3.5% this morning. J&K Bank, just because their QIP is in the works, and that stock has also been rising. It's seen a bit of profit booking over there. Let's just pull up Genus as well. So Genus has got an order for smart meters that's up 5%, and that order is worth about 1,000 crores. Couple of more because there's just been so much news flow today. Edelweiss is one that I will pull up. Edelweiss put out a press release talking about statement that an SIT will look into all aspects of the Mahadev app scam, and a prominent politician mentioned their involvement. They said nothing like that in the picture, but that stock is about 1% down. Ami Organics, another interesting play. They've got a good definitive agreement with Fermion. It's a subsidiary of a Finland-based company, and that stock about 2% up in trade.
Sorry, I'll have to come in here because we got Mr. Dinesh Khara of SBI on the phone line, because SBI has gone ahead and cut the MCLR. So we'll need to just go across to Mr. Dinesh Khara and try and get his perspective there. Mr. Khara, good having you. Thanks for taking the time out. The timing is interesting, Mr. Khara. Can you fill us in on the details and what happens next?
We have increased our MCLR rate by 5 to 10 basis points.
Sorry, excuse me for that.
Yeah, shorter duration is 5 basis points, and beyond that it's 10 basis points. And the reason is that it is nothing but MCLR has got various cost components, and it's an impact of the past increase in costs which are seen. Other banks had already increased, and we have increased it now.
Mr. Khara, the timing of this is what I want to talk to you about, because this has come in after the December 8th meeting where repo rates were left unchanged. The anticipation amongst most people on the street is that we will start seeing a rate cut, a repo rate cut over the course of the next 6 to 8 months. So would it be a fair assumption?
Different banks experience a change in cost component at different point of times. So for us, it was a little delayed impact of the increase in the cost component. So that is why when we met in the ALCO meeting this time, so this is the reason why it has come now.
Cost component is transient?
Sorry?
Is this cost component that you're referring to transient in nature?
Yeah, I mean, various components are there in the cost. So we look at the cost, we look back, and then we readjust the MCLR. So every time we meet in the ALCO, we take stock of the situation. Based on that, it has been done.
Mr. Khara, very good morning. Tamanna over here, and thank you so much for joining us on NDTV Profit and talking about the big news this day. I just, as you explained, this 5 to 10% increase in the MCLR was based on previous increases in cost of funds. It was, I would say, a decision based on previous data points. But now that there is more clarity that the larger interest rate direction is downwards, do you think that this is sort of the end of those MCLR increases? Mr. Khara, can you hear me?
No, Mr. Khara, can you hear us? Okay, I think we've lost Mr. Khara, can you hear us? No, I think the line is patchy. It'll be interesting to understand from Mr. Khara if this increase has any bearing on the home loan borrowers as well, but I think we'll try and repatch that line in a bit.
I think they have put out the circular where it does. It's 15 basis point. That's the impact that we're expecting on the long tenure loans.
Cool. Vinit, quick thoughts here while we try and get Mr. Khara back, but on these announcements, and these are tiny tune announcements per se, but the larger direction for banks like SBI?
It's not going to make much of a difference. I think that, SBI has got deep pockets in terms of excess SLR investments. which they can scale back on and fund their loan books. So definitely advantage for SBI vis-a-vis other banks.
Just stay with us, gentlemen. We'll quickly just finish up the market check and come back to you in a minute. Don't know whether we have Dinesh Khara with us yet, but we'll wait on that for a minute. A couple of other movers across the broader market. So Sterling Wilson, Niraj mentioned this counter in trade setup this morning. I want to pull that counter up and see what it's getting up to, and it's a big move there. 4.5% is what we're seeing on Sterling Wilson. A few other names that we're tracking on our radar is, of course, these are movers not backed by too much news flow, but nevertheless worth a mention. You have stocks like Policy Bazaar, IRFC, Hindalco, Apollo Tyres. So surprisingly, stocks like or tire manufacturers are still holding themselves together in early trade despite an increase in crude prices. So that's an interesting sort of dynamic that's playing out. Mr. Khara, are you with us? Can you hear us?
Yeah, I can hear you.
Yeah, I think Vishy wants to jump in to talk to Mr. Khara. Of course, he tracks the sector very closely, so I'm just going to hand it over to him very quickly.
Good morning, Mr. Khara, Vishwanath. The question that I wanted to ask specifically was with regard to the liquidity position in the system right now. I understand that some of this rate hike would be because there is tighter money in the system, but the expectation is that by January, this is expected to ease a little bit. So is the timing of the rate cut something that we need to look at closely? Rate hike, sorry.
That is something which I thought I will correct.
Sure.
So the point is that when it comes to, as I mentioned, as I explained, that it is a impact of the past cost components which get reflected into the MCLR competition. So when we take stock of the situation in the ALCO, in this ALCO, when we took stock of the situation, we felt that there is a need for increasing the MCLR by a nominal 5 to 10 basis point. But what you mentioned in terms of the tight liquidity and I think it's a effort on the part of RBI to ensure that there should be adequate liquidity, and lack of liquidity should not come in the growth of the economy. So that is something which is there in the mind, because normally we have seen that towards around 15th is time when the advanced tax goes and the liquidity gets sucked from the system. So I think just to address that kind of a short sense, this has been brought out.
Right, Mr. Khara. The other question was with regard to the impact on borrowers. Now, of course, this will directly come to the new borrowers first. But over time, how soon do you think this will get passed on to the existing lot?
See, actually, when it comes to the interest rate for the borrowers, there are multiple components. It is just the base rate. Much of it would be there are risk premium. So all those variables are there. So how much of it passed on? Yes. Normally, when it comes to our book, which is linked to MCLR, is just about 37% or so, 38%.
Okay.
So whenever they're in for repricing, the working capital loans, etc., or the term loans, whenever they are due for the repricing, that's a point of time when it gets factored as far as the new corrections are concerned. But yes, of course, as far as MCLR impact on some of the book will start showing up. So that's how it will be.
Okay. And for the time being, there's this dichotomy because the ones that are linked to the external benchmark, they are not seeing that kind of a hike. So,
no, external benchmark would be multiple other benchmarks, which are actually market determined. MCLR links, as I mentioned, are just about 37-38%. External benchmark link is about 40% book is linked to external benchmark.
Lastly, sir, when do you expect the rate turn cycle to come in? Because the expectations were some point in the second half of the financial year, but then if you look at the RBI's inflation projection, they are still not close to 4% as of September 30 next year.
I think I don't expect anything. I mean, this rate cut will depend upon how the inflation trajectory will be. So that will be the deciding factor for the rate cut.
So at this point,
we are closely watching, though it is coming down, but I think RBI is very clear in terms of it should be somewhere around 4%.
Okay, sir. Fair enough. Those are my questions. Back to you guys. Thank you.
Thank you, Mr. Kara. Great talking to you this morning. And thank you for sharing your views and thoughts on the recent action taken by SBI. Well, we'll go back to our guest. Sudeep, metals are looking good on back of dollar play. So dollar's weaker. The metal index is trading quite firm. Any metal stocks that you would look to initiate a trade on this morning, Sudeep?
In the morning, we already discussed about Nalco. So I feel I would first continue with Nalco because Nalco has given a strong breakout on the upside, and today's move has also confirmed one more swing high crossing, that is around, it has crossed 4th September swing high of 106. So I feel now the stock is headed up to 120-25 on the upside, and this could happen in the next few sessions. And apart from that, one stock which is looking good is Jindal Steel. Now, Jindal Steel has given a decent breakout on the upside, and positionally it is sustaining now above 724, 725, which was its swing resistance of September month. So I feel till the time the stock is sustaining above 725, 728 on the downside, 775 to 780 levels can be witnessed in this stock positionally in the next couple of weeks.
Yep. Let me just quickly get a take from Vinit. Top ideas on how the market has opened this morning, and look at IRFC. IRFC about 8% up, PB Fintech, Z Entertainment, NMDC, some of the names doing very well. Metals, of course, and IT index has hit all-time highs as well. What is the top idea, Vinit, that you're looking at for the day? Anything different from pre-open, looking at how the market's opened?
So, I'll tend to go with the commodity trade. I think commodities are undervalued, and while the rest of the market is chasing the momentum, I think there's great value to be found in metal stocks. With the dollar index cooling off, I think there's going to be a substantial flow of money into the commodities. The reason being that, although the US has announced rate cuts, 3 rate cuts over next year, the inflation has not actually cooled off. So we expect that, a mega bull market will play off in the metal space. Aluminum is a counter which has been moving for the last few days, and that should pick up, followed by copper and zinc. So Hindustan Copper, Hindustan Zinc, Hindalco and Nalco look very, very good from a perspective of buying into value, which can plow into a very strong momentum trade going out into the next year.
Right. Thank you, Vinit. It was a pleasure talking to you this morning. Of course, interesting ideas as well for the markets. And Sudeep, thanks a ton for joining us today. We'll take a quick break. We'll come back. The markets are holding steady. The Nifty is in positive territory. The breadth is looking good with the bias on the upside. And metals are the sector that's leading the way up in today's day of trade. We'll take a break.
back with India Market Open right here on NDTV Profit. Let's take a look at the top headlines at this hour. First, a record opening for the markets yet again. The Nifty and the Sensex hit fresh life highs at open. Broader markets on fresh highs as well. All sectoral indices trade in the green too. Metals, IT and media gain the most. The IT index hits a 20-month high. L&T Tech, Infosys and Coforge, as well as Persistent, are up about 1% apiece. SBI hikes the marginal cost lending rate by 5 to 10 basis points. Chairman Dinesh Khara tells NDTV Profit that MCLR accounts for 37 to 38% of the lending book. And oil prices rebound after surging 3% on weaker US dollar. Gold prices continue to rise as well. But it's a day that is punctuated by gains to risk assets like equities, simply because the world markets have done well. Nischal Maheshwari, CEO Institutional Equities at Centrum Broking, Johnson right now with his perspective. Nischal, great having you in the opening week on NDTV Profit. Thanks for taking the time out. Are you guys as constructive? What is it that you're telling your clients now that we are nearing 21,500?
Morning, Niraj. Morning to your viewers also and your other anchors. I think it's a good time. Basically, I think yesterday after Fed came out and said that no further rate hikes, there was less hawkishness, or I'm saying more of dovishness actually rather than hawkishness. And now rate plot saying, though Fed is saying 3 rate cuts, I think the market is factoring in 5 to 6. I think these are all good setups for risk on in the world markets. And we are seeing that in India also. So I do not see much problems on the horizon. Yesterday, I was just sitting down actually and trying to enumerate what all problems, what can go wrong in this market, because I think all positives are anyway right now factored in. So the biggest things which I see here is basically inflation coming back. I would want to actually quickly recount in 1975 when Paul Walker was doing the similar kind of stuff basically. And they cut the rates ahead of time basically, and inflation came roaring back. And that could be one challenge that market may face, or the world economies may face. And then they had to further hike and take up the rates to as high as 17-19%, which is the Paul Walker era, basically, which we all talk about. So I'm saying that is one possibility that you might see, and that might derail the whole market.
Shah, given the current setup that we are seeing, it's almost a little bit like a Goldilocks era, right? Equities are looking good, debt markets are looking attractive, gold is looking good, currency to a certain extent is also showing some sort of euphoria given the dollar weakness we've seen. What is the strategy that you'd be advising on right now? Would a multi-asset strategy be something that investors should be considering at this stage?
If you really look at it, basically, I think a lower interest rate scenario is good for equities. May not be as good for debt, basically. I think the debt has played out pretty well, basically, till now. So a lower interest rate scenario would mean good for equities and other asset classes, maybe commodities. Because as the cost of borrowing goes down, basically, all these corporates are going to make higher profitability. And so I think more risk on more riskier assets is what one should be playing on, but I would say equities is something which you should be overweight now, rather than actually trying to look at other assets being a part of your portfolio.
Nischal, good morning. Tamanna here. Great to have you on NDTV Profit and speak with you. And you're absolutely right. Overweight on equities, but then what within equities? You know, this whole question about whether large caps will now start firing comes into play. We've seen metals now have a great day, and IT a great day for a second time in a row. Your thoughts on these three segments, and if there's anything particular that you would veer towards?
Morning, Tamanna. Great to be back basically on NDTV again. So I think rate sensitive, as I was saying, basically a falling interest rate scenario, I think rate sensitive is what you should be looking at within the equity portfolio. So all rate sensitives, banks, autos, real estate, IT to an extent. I think these are the areas basically which you should be looking at. And given that the economies world over in a downward interest rate scenario is going to be start doing well, then you should be looking at commodities actually. So we are turning positive on metals and chemicals, both of them basically, another two sectors which have not done very well in the past few quarters. So we are turning positive on that. So rate sensitive plus commodities is what we are recommending.
Nischal, how do you feel about the large cap space? It's rather consistently being heard in the last couple of weeks now that there is a valuation gap, valuations look attractive, large caps have only really gone up 14-15%. Earnings growth is looking pretty solid as well. Do you believe the same? Do you think the gap between small and mid cap and large cap stocks will finally shrink in 2024? And hence, getting into the large cap space is a good idea even now?
So I think large caps is the space basically we should be getting in because it's not performed well. And I think there is a good valuation cover which you have out there. I think most of the stocks are pretty safe to play with. So whether it is banks, large cap banks or large cap ITs, I think all these large cap stocks seems to be in a good play basically at this point of time. But I'm still not of the opinion that the valuation gap between the mid caps and large caps are going to shrink very considerably, because I think this whole rally has been driven by liquidity, and liquidity just seems to be coming very, very strongly into the small and mid caps. And given that it's difficult to acquire small and mid cap stocks because of liquidity issues, and now I'm saying liquidity is the stock market liquidity. People don't tend to sell away basically in a hurry. So, and given that you have so much money coming into the mid cap and small cap funds, they just continue to buy there. So till the FIs come back strongly into India, I think the gap is going to continue like that.
I just wanted your take on, and something we discussed this morning also on the show and on the editor's cut, the kind of very intense responses coming into any fund buying enterprises, any kind of fund buying news. You have fund buying attempts by any level of company, and you have huge money chasing this. Why do you think this is happening? Is this sustainable? And in this, is there a concern that money starts chasing assets or companies that perhaps aren't that great in this frenzy?
So I wouldn't at the moment go out and say that we are in a bubble phase as yet. But I think these are the signs of creating a bubble. Actually, where you are saying that some of these stocks are up 3-4 times. I'm saying we do not cover a recently listed stock, IRIDA. Now, I do not understand basically the stock has gone up 4 times from the point of listing. So whether so we do not cover it, so I cannot say. But I'm saying this is a clear sign of money chasing or the retail chasing these kind of assets. But we are in early stages of bubble formation because economy is still doing pretty well. World economy is doing pretty well, and interest rates are going down. So I think this may go on for a while.
What is your view on some of the new age tech companies? The Zomatos, PBA, Fintech, Nykaa, Delivery. We are seeing some activity on these counters in the last few days, but nothing much to write home about. Any of these new age tech companies you would look to buy? Because I do think valuations there might be a little more compelling than the rest of the pack.
I think none of them have any valuation because nobody makes money. So all of them are whatever infinite fees. So what you have to look at is basically what kind of business model they have and what kind of potential they have. I have held my view basically for a long time. I think among the 4 of them, I'm only convinced about one business model, which is Zomato. They have created a niche for themselves, and they have created a service which has now become a part of our life. All others, I'm not sure actually basically what kind of business models they are following and whether they'll survive in the next 5 years or not. So that's why among the three, four of them, basically what I like is Zomato. I to an extent liked Policy Bazaar, but after they have announced that they want to become a manufacturer of insurance, now they are competing with their own clients. I think there also, I think there is a bit of muddiness as far as their business model is concerned. Paytm, I'm not clear what they are doing actually, basically, so do not have much strong view about that.
Okay. Nischal, we have a conversation with Jammu and Kashmir Bank up next. Now, the reason I'm asking you about this, you may not have an individual view, but here are banks which are doing these fundraisers and they are getting lapped up and seeing demand, which is multiple times what is on offer. Any thoughts on why that could be the case? And I don't know if you guys cover J&K Bank, but if you do, then what's the house view there? I'm not asking for a buy or a sell, just trying to think of what some of these mid-sized banks could do in the times to come.
So Niraj, you are in a Goldilocks scenario clearly as far as banking is concerned. You have got balance sheet, you have raised money basically, and there is a market basically where the credit is growing at 14-15%. So I'm saying at least immediately, whatever you lent in the last 1 year or you're going to lend in the next 1 or 2 years, your book is not seasoned enough for you to actually create NPAs again. So I think for the next 1.5 years, you will be in a Goldilocks scenario, and I think that's what market is playing. And I think the investors are also looking at saying that if it is reasonable valuation and if there is an upside of 15, 20, 25%, why not acquire it? So that's what my thought remains to be for most of these banking scenarios. Now, I think at least for the next 1 or 2 quarters, I think banking should continue to do pretty well. And in a falling interest rate scenario, historically, we've seen that banking always does well. So for the next 1 or 2 quarters, I think things are pretty good for them.
Just, as we wrap up, your closing thoughts in a market like this, जो बिल्कुल थकता नहीं है, what would be your outlook and your advice? Is it time to continue deploying fresh capital, sit on the sidelines, maybe wait till, Jan, Feb and see what happens there? What is your strategy? Are you already in the New Year's year-end mood, or is there more work to do?
So I think you should be 100% invested. There is no question about that, basically. Yeah. I still see there is a good upside in this market. And now you have to be very, very stock specific, basically, because I think the broader rally has already happened. I think 22,000 is a good level of Nifty, which I think the next 6 months should be achieved. And thereon we would all start worrying where are we headed. But individually, I think that would be only 10-12% upside from here. But I think individually stocks will give you maybe 30-40%. So you have to be now stock specific. I'm saying avoid stocks and businesses which you do not have very strong views about. I think this is not a time for you to now start going and acquiring them. And that's why I was saying basically you should be in large caps at this moment. It makes a lot of sense because I think large cap has underperformed now. I think at least it will continue to be a market performer going ahead. So, and the companies are there much better quality.
Right. Thank you, Nischal. Good talking to you this morning. That's the verdict coming in on the street. You should be 100% invested. We are heading towards a bubble, but still not there yet in so many words. We'll take a break. We'll come back. We'll talk to J&K Bank. All eyes on their fundraising plans. They've approved a QIP of 750 crores. Baldev, Prakash will join us on the other side, so stay tuned.
Back with India Market Open right here on NDTV Profit. This morning we were speaking about the demand for paper, quality paper or otherwise. Well, J&K Bank would qualify in the former because their fundraise saw some, and it's you can call it a fundraise. In some cases, some of these banks are doing these asset sales or share sales in order to bring or comply with the norms as well. But J&K Bank has had a terrific last 12 months, and it figures in the way the demand for the paper of J&K Bank was in the recently concluded fundraise. Mr. Baldev Prakash, Chairman and MD of J&K Bank, joins us right now on the show to talk about what's happening within the bank and what is the outlook ahead. Mr. Prakash, thanks so much for taking the time out. Good morning. This is Niraj, Shah here from the NDTV Profit Studios. Tell us tell us how the last 12 months or last 24 months have been with regards to the internals of the banks, and how does that set you up for what is to come ahead?
Yeah, thank you, Niraj. So the last almost 24 months have been actually a very interesting phase for the bank. And not only for the bank, but this entire territory where we operate. Our maximum branches are in Jammu and Kashmir and Ladakh. So this territory has seen a lot of positive changes, and obviously the impact of all ecosystem has been on J&K Bank, because the majority shareholder as far as banking is concerned is Jammu and Kashmir Bank. So given that these changes are still continuing, we are quite hopeful that the economy of the core territory of Jammu and Kashmir Bank will have a continuously positive impact on the earnings of the bank also, as far as the core territory is concerned. And the rest of the country, our strategy, which happened last year, that we will continue to grow in the rest of the country with high-rated good corporates, that will continue, and that has been successful over a period of time.
Mr. Prakash, previously you've talked about 20% credit growth for the next few years. Do you still hold that number, or do you think it could be a little more ambitious than a 20% credit growth? And also in terms of expansion, you indicated that you are looking to grow from outside Jammu and Kashmir, and you have stepped out of that state in so many words. Which state, what sort of growth numbers? Can you draw out and chalk out that plan for us?
Yes, Samina. See, our overall growth during these 6 months have been around 16%, and our guidance has been mid-teens. We will be maintaining that guidance, 20%. As far as the overall growth is concerned, I think for this year we will not be able to achieve that. But as far as the housing segment is concerned, we are already growing by over 20%. Which will see definitely more than 20% growth, and that is again driven by the housing segment investment in our core territory of Jammu and Kashmir, and that will be sustaining for a longer period of time. And as far as expansion is concerned, we are already there in all states except Northeast and Odisha. So Odisha, we will be opening one branch in the capital area of Bhubaneswar, and in other places also, strategically, wherever the opportunity of business is available, we are opening around 15 to 18 branches by March 2024.
Mr. Prakash, you sound confident about the nature of growth happening in your area of operations. Do you reckon that growth would be, as Samina asked, slightly more fast-paced, independent of the fundraise that you've done for growth capital? Simply because if indeed the economy of the state and the areas that you are operating in moves up, there is a direct operating leverage that comes into the lenders per se. So my question really is that would a lot of the growth capital be essentially used for extending credit growth? And what are the factors that could lead to you beating the modest estimates they are laying out? Because I use the term modest because the investors who I speak to talk about the growth rates being a lot higher in their minds versus the numbers that you're talking about right now.
So Niraj, I think we are in a phase of transformation as far as digitization of the bank is concerned, which will continue happening up to March 2024. So once the digitization is over, and the dependency on human resources as far as the retail segment is concerned is lessened. Yes, maybe next year we can see some uptick as far as growth is concerned in credit. And overall, the territory which we are operating as a majority market shareholder, we'll see, I'm very confident we'll continue to see the heightened economic activity, which will be supported by the tourism, which has been all-time high. And this year also, we are seeing that tourism will grow much faster pace as compared to the last years. And then the lot of investment is happening in the infrastructure segment. Lot of roads and tunnels are being built, and then the horticulture, which is led by high density apple crop, will also be another segment which will be seeing phenomenal growth maybe in the coming times.
So are you being, your FY24 loan growth guidance of 15% is fine, Mr. Prakash. Are you being conservative? Do you hope to under-promise and over-deliver? Is that why the near-term growth rate targets are set at 20%?
Yes, we actually follow the same policy that we should not unnecessarily over-promise, and we will try and over-deliver to our shareholders. But this year, because I told you we are in the transformation stage, we are digitizing the bank, and by March 24, that journey will be over. So after that, we are expecting maybe better credit growth will happen.
Okay, just one quick follow-up to that is, do you reckon, in some sense, banks which are building out, there's a lot of talk of how the asset quality, the NPA cycle looks dramatically different than what it looked to in the past. But in case of banks which are quote-unquote building out, that problem is going to be even lesser. So my question is, would you reckon that this 15% or 20%, whatever number you clock in, FY24, FY25 beyond, could happen at near pristine asset quality, Mr.
Prakash? Assets quality and the NPA, gross NPA reduction has been the biggest success story of our bank. And I can assure you that as far as the overall assets quality is concerned, the onboarding of customers has seen a tremendous improvement as far as our bank is concerned. Lot of internal processes have been improved, and because of that, only the quality customers are being onboarded, and the proof of that that can be evidenced from the slippages, which are hardly anything as compared to the last years. So as far as the assets quality is concerned, I'm not very much worried about that in the near future.
I'm glad you bring that up, Mr. Prakash, and that brings me to my next question for you. How is your restructured book looking? Any signs of any slippages there, or you're pretty confident that that book is in a good place right now?
Yes, Samina, this book is absolutely in the best shape as of now. You'll see that there's no slippages out of the restructured book. Whatever is happening is only these assets are getting upgraded to standard assets. So almost 50% of that book has already slipped 2 years, 1.5 years before. After that, whatever is left will be only upgrading.
So do you think there could be further improvement on your NPAs? I mean, you've gone from 9.6 in 2021 to a very healthy 5.26 number as of September 23. Some more improvement expected on the NPAs?
Yes, this journey will continue, Samina. And this year, our guidance has been at 4.5%, and I can assure you that we will be living up to that guidance, even improving from that. As far as net NPA is concerned, we have come after a long period at 1%, and we will be ending below 1%, substantially below 1% this year end.
So I want to ask you two very quick questions. Has the J&K state showed any willingness to reduce the promoter shareholding, because that is still stands at a substantial 64%?
Samina, after this QIP, it will be around 58%, both UTs, Jammu and Kashmir as well as Ladakh. So for Jammu and Kashmir, it will be around 55, and for Ladakh, it will be around 3.5%. So from that point of view, the majority shareholding will continue to be with the union territory governments, and they will in the future also they will continue to be the majority shareholders.
So they will still retain majority stake, and that's a fair assumption to make. Also, with this QIP issue that's lined up, and like Niraj is indicating, the response has been fantastic. Investors are very excited. I mean, you are being touted as the man who's the turnaround story for J&K Bank. Quick last question on that front. Where are the proceeds going to be used? You've talked about expansion. Is that largely where the money is going to go into, or would you look at sprucing up your balance sheet?
So, Samina, this money entirely will be utilized for growth of the bank, growth of the credit. And we don't have any other liabilities where we will be utilizing this money. That's why we have been telling our investors that for the next 3 years minimum, we will not be requiring to raise any Tier 1 capital. And because of that, our investors have given us a tremendous response, and I'm very happy and always thankful to them.
Lastly, Mr. Prakash, provision coverage ratio stands at 99%. Very clearly, your balance sheet is very well protected. How is the underwriting improved to protect against future stress, if at all any? Just as a bank, I'm assuming those are things you do to ensure that the future assets are also not, there is no stress as such.
Yes, so I can give you a proof that if you see my slippages ratio, hardly any slippages are happening as of now. And a lot of steps we have taken for improving the underwriting standards and for the decision making and for improving the quality of people who are working in credit. And these people will be working in credit for a longer period of time, and their trainings and their other requirements are being taken care by us. So we are, running the bank in a perfect fashion as far as credit is concerned, as far as the quality of assets is concerned. That's why I do not have much worries.
Okay, I have two more pointed questions, Mr. Prakash. For a lot of PSUs, employees of senior age retiring would mean significant cost savings over the course of the next few years. Can we expect this in J&K Bank's case as well? Would there be some numbers that you could help us with when it comes to the impact of such a thing, if it were to happen in your bank?
Yes. So, Niraj, this is the only thing which I need to fix now, the cost to income ratio, where we are still outliers. And I can assure you that we are very much on this job. Maybe another 2, 3, 4 months time, you will hear the good news. That is one. And as far as the employee cost is concerned, 1,500 senior employees, that is scale 3 and above, they will be retiring in another 3 to 4 years time. And once these employees will be retiring, our provisions for the pensions will be coming down, and the new employees which will be replacing them, or which have already replaced with a lot of senior people, they are joining on the NPS. So from that point of view, the bank will not be requiring for any provisions for pension. So this will be supporting factor as far as the cost to income ratio is concerned. We are taking a lot of steps on that.
Okay, so strong credit growth, better cost to income ratio, hopefully other revenue streams as well, or income streams, CRM solutions, etc. There is an expectation that in the minds of the market that the number of profit of 4,000 crores, which is spoken about, and which I believe you've shown comfort that you would probably reach in FY28, if I'm not wrong, could happen earlier too. What would you say to that, Mr. Prakash?
So as of now, Niraj, I will stick that by March 2028. The documents is already in public domain. We will live up to the expectations of our shareholders. We will try to improve it further, but definitely we will live up to those expectations, including the profit after tax.
Right.
Samina, under promise, over deliver.
I
think he said
clearly
that.
I think that's going to be a takeaway, Mr. Prakash. A tagline when we say J&K, under promise, over deliver. But good luck with business. Congratulations. You've obviously done a fantastic job so far, and hopefully things go well for you in the bank.
Thank you very much.
Thank
you so much.
Thank you. Well, on that note, J&K Bank, have you seen the rally on the counter, Niraj? The market is excited. The stocks gained over 25% in the last 7 trading days. So it's euphoric. It is a bet from the PSU banking space. The banking, mid-cap banking as a whole continues to be in a sweet spot. And this one is also a top favorite, like Niraj has indicated. That's largely what it is. The markets in the interim are looking good. We are holding steady. at 21,311. The breadth has deteriorated just a slight bit since we opened trade this morning, but nevertheless, no concerns yet. It is clearly dollar play once again. A weaker dollar is doing well for metal counters. So those have done what IT did yesterday. They're the lead gainers in today's trading session. So your Hindalcos of the world are trading firm. You've also got IT that continues to look sweet. So Infosys, LTI, Mindtree, Wipro are still counters from the IT pack that are trading firm. Niraj, anything else that you're spotting that's looking good right now?
No, just before we slip into the break, actually, can we pull up the advanced decline ratio? Samina was talking about the breadth. So just pull up the advanced decline and just see what's happening there. And just at the broader end of the spectrum, Amber, because of that UBS coverage, note is up about 6%. So that is one to focus on. And lo and behold, there is some strength in chemicals today. We were talking about it today. Deepak Nitrite, Balaji Amines, Alkyl Amines. These are three that I can already spot. GNFC is the fourth one, which are doing well. So chemicals, Tata Chemicals is up 3% too. So chemicals certainly buzzing in trade. Take a quick break. Come back with the big market voice of the day, S. Naren of ICICI Prudential AMC on the other side. Thanks for tuning into Talking Point on NDTV Profit. I'm your host, Niraj Shah. Our guest today is, I can use the term indomitable, S. Naren. Naren, thank you so much for being a part of the show.
My pleasure.
Naren, tell us, for everybody who's invested in equities, I think the last few days have been a bit of a dream up move. Valuations may have been stretched. Global markets may not necessarily have been the most supportive. But we've had a good move thus far. How do you approach equities currently?
See, it's a very, we manage other people's money, and we've been managing other people's money for a long period of time. So as far as the old money is concerned, people, I should thank all the people who have invested with us in the earlier days, because they got very good returns. even for the people who have to consider, we are in a boom market. For a long period of time, we have had a boom only in mid-cap and small-cap in recent periods of time. If you look at the 2-year returns in large-cap, bulk of the returns have come maybe in the last 1 month or so. So we have a situation where the boom in large-cap has just started. And that is the challenge, how long this boom lasts in large-cap, because the valuations are not cheap. But for 2 years, large cap has kind of underperformed mid cap and small cap, and that is the challenge. We've looked at earlier years in ICICI on election years like 2009, 2014, and the challenge for us is, I think the quantum of rally is going to depend on the quantum of FII money which comes. And it is very difficult for a person like us to predict how much money will come, because they have not been investing after 2021. For 2 years, they have virtually not invested except for small periods of time. So it's a tough task at this point of time. But the real move, I think, is going to be in large caps, and how much the move will be, we'll never be able to predict.
Coming from you, that's an interesting answer, Naren. Is that because, one would presume that at some, valuations plus earnings would form a part of that. So and because you are getting the monies every month, what do you do, even if you can't predict? What are you doing currently then?
See, our model is very simple, that, when we get the money, we have to invest. And it is not that there aren't any fundraising happening. So if you look at this year, for example, on a continuing basis, we have had QIPs, we have had IPOs, we have secondary sale by a lot of private equity. That has ensured that a lot of the money that has been raised has gone into that actually. So it is not as if, the money has come and you just bought all the stocks in the secondary market. Bulk of it has actually gone into primary. If you look at these 3 groups, that is IPOs, QIPs and secondary sale by people like private equity. So that's what has happened actually. So it is not as if the money has just gone into the markets fully. That's not happened actually.
That's true. But so therefore, so when you get money which is scheme agnostic, let's say it's in a flexi cap scheme coming in, then you are comfortable probably putting more allocation to the large cap pocket, because I heard you use the term boom when it comes to large caps and not as much in mid caps and small caps. Would that be a fair assessment?
Behaviorally, I keep telling my colleagues in my team, invest more in large caps. But imagine the kind of boom we have seen in small cap and mid cap. It's been very tough to say I won't invest in mid cap and small cap, because every mid cap and small cap goes up like one rocket.
That's true.
Whereas if you look at most of the mega caps over the last 2 years, what returns have they given? They've given hardly any return. So it is not as if any AMC would have said, I'll not invest in mid cap and small cap. I'm sure even in the flexi cap funds, there would be a fair amount of mid cap and small cap at this point of time. Because the reality is that if you had avoided all the mid cap and small cap, it would have been very difficult to do returns.
But here on?
Here on, I really think 2024 is going to be a year of large caps.
Large caps, okay.
Because you have had 2 years of, very little money coming from FII, and I think 2024, the returns have to come if FIIs come. If FIIs say, I'm not going to invest, I don't think you're going to have big returns, because I think domestic investors have invested significant amount of money.
Most certainly. Thanks to mutual funds, PMSs, AIFs, etc., the amount of Indian equity in the hands of the Indian investors has been fairly large, which is a good sign. Okay, let me try and we'll come to the risks as well, Naren, because I'm sure in your mind, whenever I've spoken to you in times of euphoria, you're the first to highlight the risks as well, and we'll come to that. But I first want to dissect how you're thinking as a portfolio manager about what within this bucket as well. So banks have started to move, yes, but clearly far away from the kind of gains that Nifty per se has made as a benchmark, or some of the other sectors have made as well. Is there a case for banks to give good returns over the next 12 to 24 months? Why or why not?
I think banks will give reasonable returns, but banks as a sector is not an underinvested sector among all the funds. So if we are all going to get money and FIs are going to get money, what is the sector they'll invest in? Banks certainly. So I think banks are certainly going to do well as money flows. At the same time, if money flows out, they are the sector which people sell. So you have to keep that in mind. But from a cycle perspective, I think it's the sector where there's been fair amount of negative impact of net interest margins peaking out. There have been a lot of concerns. I don't think there is any big risk of near-term non-performing loans going up. The corporate sector has been in fine fettle. I think the banks with a very good deposit franchise are going to do well over the next 2 years. But finally, it's dependent on flows. Banking is dependent on flows. Okay. If FIs get outflow, they'll sell banks. If domestic get outflows, they're going to sell banks. If, on the other hand, if each of us are going to get inflows, we are all going to buy banks because it's almost 30% of the benchmark or more than that at this point.
Yeah, but domestics have gotten flows thus far, and yet banks, despite having good valuations or valuations in their favor relative to the recent historical averages, haven't quite moved. So do you think now finally the time can come, because along with domestics, if FIs also get in money, that's when the money
absolutely,
that's when the
absolutely, I think that is clearly the situation.
Okay, what about NBFCs? There is enough warning given by the Reserve Bank of India as well around unsecured lending. Again, if a rate cut trajectory is something that we anticipate in 2024, that might have a bearing for both NBFCs and banks as well. So how do you look at NBFCs in that regard?
See, in NBFCs, you have to be much more careful. I think the real area where we have to be careful is fintechs, but fintechs are not listed. So luckily for us, we don't need to look at them. In the case of NBFCs, there are some fantastic NBFCs who manage risk as well as a bank. So in those cases, we have to do actually a valuation analysis rather than a risk analysis at this point of time. And it's not that they have mismanaged their risk in a way that we have to worry about. But NBFCs are also, there are good NBFCs, average NBFCs, below average NBFCs. There are very good NBFCs. You can't look at them and say, you can say all of them are one way and say either positive or negative at this point of time. And the reality at this point of time is, I think the deposit market is equally important. The people who are able to raise resources cheaper, I think they have a good situation, whether it is in the NBFC market or in the banks market.
Got it. Naren, what about non-lending financials? There, the performance has been fairly divergent within the capital marketplace as well, wherein AMC stocks haven't quite given the returns that some of the others in the capital marketplace, be it the brokers, be it some wealth managers, be it the platform companies have. And then the non-capital marketplace, insurance, you would argue that you can almost say that they are being stagnant, if you will. I mean, I was looking at returns of the private insurers since 2017 that they have listed. A 7-year return is 120%. That's nothing to write home about, really. So what about the non-lending space, non-lending financial
I think
space?
you have to go bottom up there. And I mean, some of them have gone through sideways movements for some periods of time. So I think we have to do a lot of bottom up work there and then do the analysis. So I think as such, it can't be one way looking at it. And some of them, the cycles have actually, last year they had a fantastic January to March. So the base effect is a challenge for the next 3 to 6 months. But once people realize it's actually a base effect in play, I think people will realize that the long-term outlook is still good and you can't look at year-on-year trends. How many people look at year-on-year trends is going to be interesting, because last year Jan to March was fantastic for various reasons in insurance. So people shouldn't look year-on-year. If they start looking at year-on-year, the near term will look average in insurance. And that is, those are the kind of things that we have to look at. See, as such, if you look at the market, there is no pocket which is very, very cheap. I mean, we have had such a big bull market that if we come and say, okay, I'm going to look at this area of the market, this is very, very cheap and invest aggressively, that scope just doesn't exist at this point of time. You have to look for only relative cheapness or hope for a trade which moves from being fairly valued to overvalued. That is a trade that we have to look for. Can it happen? Yes, because India is one of the few structural stories in the world at this point of time. And for a person like me to say, okay, I look for a trade from fair value to overvaluation is something which is very tough for me. But it is something which could well happen in the year 2024 at this point of time.
And what would be the catalyst for such a thing? Earnings growth or the fanfare around investments that might be happening? What could lead to that?
The catalyst is actually that Fed cuts rates. Then people say we have to invest in emerging markets. then anyway domestic flows have never slowed down. So you have domestic flows, on top of it FII flows. Actually in the last 2 years you have had a situation where you had domestic flows but not enough FII flows. So you have, if you have a situation where you have both domestic flows and FII flows together, that makes for a very, very uncomfortable market for people who look at valuations like we do at ICICI.
Got it. Just before we take that break, and then we'll of course talk about some of the pockets that Naren particularly may be liking. But just wondering, Naren, there are people who are saying that there is a very high probability because of all the factors that you mentioned and the fact that we are looking reasonable on growth on the country front as well, that India may eventually be the emerging market which may reach stratospheric levels on valuations, even bubble territory, because there are not too many games in town. Would you, when you scan the global landscape, do you get such a feeling too?
It is possible. See, markets in the near term are completely unpredictable, and when we look and compare all the big emerging markets in the world, how many markets are there where you have a macro where fiscal is under control, current account isn't under control, inflation is under control, corporate sector is in good shape, and the only problem is high valuation? I'm not able to see an emerging market with all these situations. So can it be? But does it change? See, valuations can go up in the near term, but in the very long term, valuations do play a role. And that is a challenge, particularly when we are managing other people's money. True. So in the near term, valuations can go as high as anything you want. And this is the learning from years of managing other people's money.
But is there a case that this can happen in 2024?
There is a case that it can happen in 2024, and it's a worrying case when you're managing other people.
Okay, great. Now, Naren, I've asked you about one of the key pillars, which is the largest weighted, which is financials, and we've discussed that at length. I would love to understand, where is it that you believe that earnings growth looks set as remaining strong, or the probability of earnings growth is strong for the next 2-3 years? Because there are a lot of pockets in which either there is government capex happening. I know export demand is not quite there, but maybe possibilities later. So what is it that Naren likes?
See, I think we clearly like mega caps. See, over the last 3 years, what has happened is slowly, if you look bulk of our funds, you will find that mega caps have done so badly compared to small cap and mid cap. So people have asked this question, go across sector, you will find that the smaller banks have done very well against the larger banks. Look at the smaller IT companies have done very well against the larger IT companies. Look at the smaller consumer companies have done very well against the larger consumer companies. So across sectors, what you see at this point of time is that the mega caps have done badly compared to the smaller companies. And if you look at, by and large, the portfolios also, you will find that people are underweight the mega caps compared to the benchmark, and they've benefited out of it. So I think this is the year where you go and say, let's buy the mega caps, because the mega caps have had now 3 years of big underperformance.
Yeah, sure.
And people have asked us 3 years back the question, why don't you have these mega caps? And at that point of time, it was a tough time to tell people they are not looking cheap. The mega caps or the quality stocks at that point of time, they were not looking cheap compared to the small caps or the PSUs or the telecom companies or the metal companies and various other things. 3 years later, those companies have gone sky high, and these companies have barely participated. So this is what we think at this point of time, and this is to execute this, and then you never know how long these trends change, how long you go back, and that is where it is. That is where there is relative value. As I said, there is no pocket of where markets you can say is absolutely cheap. So you look for relative value at this point of time.
But within what themes? I mean, mega caps, there are a few of them, but they are present across multiple sectors, but with maybe one or two sectors being the key drivers. So what within this mega cap universe thematically do you like more?
Everywhere you go across, as I said, you go across banks, you go across consumer companies, you go across IT companies, you go across conglomerates. Everywhere that is the situation at this point of time. And if you look at it, one of the things that we believe at ICICI is bad news and bad share price go together. Good news and good share price go together. 3 years back, people said, how can PSUs deliver? And it looked like PSUs can't deliver. Today, does anyone ask these questions? No one asks these questions. So somewhere, and today you can find a reason and say this mega cap has this problem. That mega cap has that problem. I'm sure you'll find an answer why this mega cap is not delivering. But the reality is that, good news and good share price go together. So we look for bad news and bad share price to go together. And then sometimes some of these things revert back to mean. And the challenge is patience. And that's how we think about it at this point of time.
Yeah, so I can completely buy your point about how banking mega caps, for example, haven't quite had the move. There is a case maybe for valuation multiples to re-rate, as the case may be. What about information technology there? There are a few out there which haven't made a move, but the arguments that come in on almost all notes that I read is that discretionary spend, if anything, will not come back in a hurry. So is technology on the back burner, or do you think even tech, there is a case being built there?
I think no, basically you maybe in these sectors you will have to buy more gradually, because the near-term outlook looks so bad. But it is not that, information is democratized now. Does Niraj know it? Yes. Does the viewers of NDTV Profit know it? Yes. Does so many people know it? Yes. So what happens is, over a period of time, everyone knows that the outlook for discretionary IT expenditure in 2024 is bad. It gets priced in. And once it gets priced in, sometimes what happens is the opportunity still exists because almost everyone knows it. And everyone goes underweight the sector. And that happens. And that is part of investing today, because compared to the 90s, what is different between 90s and today is that information is fairly democratized. Even if you have a good internet connection and a good laptop or an iPad, you will know that there is a problem in discretionary IT expenditure in 2024.